Welcome, everybody. This is Chris Smith from theoptionclub.com. I see we have about half the people who registered, so we're going to probably get started in about 2 minutes and give everyone who's trying to get in an opportunity to do that. I've got Steve Lentz with us tonight. Steve is over there with OptionView Software and Discover Options mentoring program. I've known Steve now for a few years, and he's done presentations for us in the past on a variety of subjects. And most recently, what caught my eye was his development of what he calls the Lentz Volatility Indicator. And I will not steal his thunder, and so I'm not going to talk about the indicator. I'll let him do that. Before we get started, though, what I'm going to do is remind everybody online that this is a presentation for general education purposes, that neither myself nor Steve are we're not going to provide any investment advice or trading recommendations, but we're going to see what we can do about helping provide you with a better understanding of options, about volatility, and specifically about the Lentz Volatility Indicator. Steve, are you online?
I sure am, Chris. Thank you.
Yeah, I'm watching this little ticker here with the people coming in, and looks like we've got a few more people coming in. But I think what I'm going to do, because I don't want to cut your presentation time short, I'm going to throw this over to you right now, and what you'll do is you're going to have a button on your screen that looks like the play button on your VCR.
Ah, okay.
And when you press that, then whatever's on your screen will be shared with our audience.
Okay, that might be scary. No,
it could be.
All right. All right, here we go. I'm going to click Show My Screen. Here we go. All right, there we go. And then let me hit F5. Okay, now I'm looking at my screen. It says timing non-directional, and then I have this whole thing. Can I just minimize this thing so it's gone? How do we get rid of this?
Oh, you're looking at the control panel there?
Hide control. Oh, there we go.
Yeah,
does that work?
That'll shoot it over, and I'll monitor all the questions, and that way you don't have to worry about doing that.
Great, because I can't see. Is this the one where those little questions pop up real quick and then go away?
No.
Just in time for me to, okay.
Actually, I don't know if you're getting the questions or not on your side, but usually what works pretty well is I'll keep an eye on things, and either at the end of the presentation or if it makes sense to handle the question in the midstream, so to speak, we'll do that.
Excellent. Well, Chris, I just want to thanks a lot for having me on. It's a pleasure and a privilege to speak with you and the Options Club group. This is great. I'm for the last couple months I've been kind of on this theme a little bit and of timing non-directional strategies with volatility, because in our own mentoring program, our core strategies are primarily selling premium in a non-directional way. And I know your group is, you guys have, I'll speak to the group now, you guys have all heard about these strategies, and I know you've had Dan Sheridan on, and he talks about some of the same things. We have our own little spin on the way we like to do adjustments, and this is something that we, in our view of volatilities, might be a little different. We all agree, though, that these strategies work, and this is just a little bit of a refinement that I think can help improve the timing and maybe the contract size that you're using when you employ these strategies. Okay, and so let's just, without further ado, get going here. Let me see here. There we go. Condors, butterflies, calendars, and these are all in the context of non-directional strategies. And so I'm showing you here a picture of the condor dialed up in option view in the graphic analysis. And you know, I'm assuming there's a few folks here that are kind of new to looking at these things, but you know what you're generally observing here, let me get my little pencil here real quick, is when you put on a Condor, the nice part is that all this area above the zero break-even line is profit, and with a Condor you can encompass a huge, wide section of price outcomes in the future where you could be profitable, and so you have a nice profit profile going way out on the wings out there, and that's why it's called a Condor. You go to a butterfly, okay, and again, this is a non-directional strategy. We can make money no matter which way the market goes. Again, non-directional, and of course you make money in the over the course of time. In this case, 36 days to expiration, all right, halfway between expiration and so forth. And so if you're getting into options trading just at the beginning, these are pictures and graphs that you'd really need to learn how to understand so that you can trade some of the more sophisticated and profitable strategies. I think in the course of time and doing this over many years, talking to a lot of traders end up going the non-directional route. All right, and I know there's a lot of directional people I'm talking to, and my hat's off to you. I like to trade directionally myself, but you know, in the world of options trading, you know, what we find is that at the end of the day, folks will land on the non-directional strategies if they want to. Now, if they want to grind out a return most months out of the year. Now, of course, we're all in trading for different reasons, right? I'm reminded of that book, and I'm looking at it on my shelf. I'm just looking down here. Market Wizards by Schwager. There's a guy in there, Ed Seykota. He was interviewed back in, I think, the late 80s is when he wrote that book, and he had a great quote in there. He says, everybody gets what they want out of the markets. Everybody gets what they want out of the markets. If you're in the markets for a good income, consistent, well, if you're in the markets for that reason, you're going to persevere and you'll find the approach that will meet you there. All right? And if you're in the markets because you have a desire for the thrill and the action, well, there's a place in the markets that will help you find that. The markets offer everything to everybody, but it's important that we understand our motivations for doing this. Okay, why are you in the markets? Is it to really make an income? Really? Ask yourself that. I mean, are you really in this to do that, to make a consistent income? And if not, that's fine. You know, I know option traders very well. I work with some of them. I work with some of them, and they're in option trading for a different reason. Okay, and it's sometimes it's the thrill, it's the action, it's the thrill of the hunt. Okay, so anyway, we're looking at a calendar spread here. I was telling Chris earlier, I just looked up and I see the calendar here. I have one of those goofy setups in my office. I was on vacation a few weeks ago and ran into a friend, and he had one of these stand-up desks. You know, Donald Rumsfeld used that, Winston Churchill. It's you kind of stand at your desk so that you burn more calories and stay in better shape and all that. And, you know, after, almost 25, going on 30 years of sitting at a desk, it's kind of wearing on me a little bit. And so I'm trying to stand up and do this at the same time. It's just a little different here. So, all right, I'm looking at the calendar. I spin around. I look at the calendar. Non-directional, you can kind of see clearly. You can make money no matter which way it goes. You make money over the course of time. Now, in talking to our mentoring students and in talking to our mentors over the years, you know, our mentors, the guys that are teaching, I've gotten comments that go something like this. You know, Steve, it just doesn't seem like it's a good time to do Condors right now. It just seems like the market's volatile and it's a bad time. Or I'll see comments, you know, in classes being taught, you know, how to trade in these volatile markets. And, of course, then you look, and, of course, it's a perfect time to sell Condors when they're espousing that whole thing. So I came up with this notion. I said, gosh, you know, there's got to be a way of quantifying from a volatility perspective what kind of a season we're in so that we can document and quantify and definitively say, yes, you know what, the market right now is not a good environment in which to do these market-neutral premium selling strategies. Or we could say, you know what, now is the time. It is a good environment. Yeah, we had a volatile day yesterday or the day before, but you know what? All in all, we're in a season right now where it's a good time to do this. So what can we do? How can we quantify that? And so that's what I want to work at here today, is I want to work our way towards building an indicator that you can understand exactly what it's saying, and you would understand the philosophy behind it. Okay? Now, by the way, we're talking here about non-directional strategies in the context of equity indexes. I'll say this, equities or equity index options, primarily equity index options, SPX, Russell, Spider, IWM, these kind of things. Okay, we're not really talking about this in the context of, futures and grains and all that stuff. Although it would apply, well, the whole thing would apply, but you're going to see here why the indexes work so well. So here's the outline for today. We're going to go over probability and volatility and the theory behind that, kind of as a backdrop. We'll look at different types of volatility. We're going to look at overvalued options for selling, what makes options overvalued, and our definitions there. We're going to look at what happens when things go wrong. From a volatility perspective, when things go wrong, what's actually happening there? We'll build an indicator after we go through this backdrop here. Finally, we'll look at applying the indicator. Okay, when we get the indicator, how do we apply it? Okay, so, and then, this is a part, I ran out of time. I know we're not going to have time to get into this, and I did speak on this at the Money Show at the Traders Expo here last week. So unfortunately, I just didn't cancel this last part out on using OpScan. So let's talk about probability. This is a picture, and this is in Natenberg's book, and someone took his concept and dialed up a website. And years ago, I went to that website and I grabbed these screenshots. It worked out really well. You would click a button, and these little yellow balls would begin, drifting down from the top, right in the middle here. Right in the middle, they would start dropping down. And the yellow balls would bounce and bounce, and over the course of several minutes, they would start accumulating down at the bottom of the page. And this was a website, and you could just watch these little balls do it, and kind of, like you could just watch them all day if you wanted, because the thing would just build up. But what happens is the balls drift down, and they bounce around these little green barriers. Most of them fall somewhere in the middle of the page. Some of them, though, bounce on the little green barriers and make their way out onto the edges. And this is what we're doing, is kind of building a picture of the normal distribution. And what happens over time is you get these balls that have dropped, and they've created what we're going to call a bell curve, or a normal distribution of outcomes. And not only with these little balls, but with stock prices, with populations of people answering psychology questions. Statistics is applied into a variety of disciplines out there. And what you do, though, is you take these outcomes and you divide it into sections. And I know many of you know this like the back of your hand, okay, probably even better than the back of your hand. I mean, how well do you really know the back of your hand, okay? But you know this probably better. You carve up the bell curve into segments. The middle portion, by definition, in the world of statistics, is called the first standard deviation, and it occupies 68% of the possible outcomes. 68% of the possible outcomes. Now, just as a little add-on, let me see, what can I do here? Okay. Look at the border. This is the border of the first standard deviation. I'm drawing these red lines going up. You see that? Okay. So the balls will, 68% of the balls will end up in that first standard deviation. Now let me ask you this question, just to see if, you don't have to answer, but let me just ask this. when a ball comes down from the top and starts bouncing around, okay, out of 100 balls, how many are going to strike the border of the first standard deviation on either side? Okay? Now we know that 68% will end up down there in that little section there, but in the course of the journey, what is the percentage of the balls that will at some point strike one of these sides? Now mind you, the balls can drift down, hit a border, and drift back, or they could come down, hit the border, and then keep going. Okay, the question on the table, and this is just an add-on, this is kind of an aside, but when we sell premium a standard deviation away, it's important we know that roughly a little more than 1 time in 4, this ball and typical occurrences will hit one side of the standard deviation or the other. Just a little under half of the balls are going to fall into the middle without striking the borders there. Okay, and you can see that in option use probability calculator. It's a Monte Carlo based calculator. I think Macmillan has one too. And they all kind of speak the same thing, and the same numbers come up. But that's just kind of an aside for those of you that like to sell credit spreads a standard deviation away. Your system that you devise has to be better than 75% winners for you to have an edge. Randomly, you could sell premium on one side or the other and have the 75% winning situation, but you got to beat that number. All right, that said, second standard deviation, 95% of the balls end up within the borders of the second standard deviation. Finally, the third standard deviation occupies something just over 99% of the possible outcomes. Now, you are going to get those little outliers out here. All right, you see that? And so that's that extra little percent. And in reality, we could talk about leptokurtosis and how the tails out here are in reality a little bit fatter than what the theory goes. That's a discussion for another day. All right, but there you go. First, second, and third standard deviations. Let's now paint the bell curve, these colors, just to give us a tool for grasping volatility, okay? We paint the first standard deviation red, the second green, and so forth. Now, let's back up a bit and just talk about the notion of volatility. Okay, let's define volatility as a concept so that when I tell you volatility is at 18%, we know really what that means. Well, when I say volatility is at 18%. 18% of what? In how much time in the future? We have to understand what the term volatility means. And so we're coming back. We're going to look at the forest, all right, from an elevated position here, and we're going to just examine the broad concept of volatility. So here it goes. The term volatility speaks to a 1 standard deviation price change in the underlying asset as of 1 year from now, expressed in percentage terms. Okay, now that's the term volatility. Now, of course, we're working our way towards an indicator, but to understand the indicator, we got to understand what volatility is. Volatility speaks to a 1 standard deviation price change in the asset as of 1 year from now, expressed in percentage terms. So let's just bring up a price chart. Let's throw on that bell curve going into the future just to kind of warm up to the visual aspect of this. We got the price going up here, and we're casting a bell curve target out here about 2.5 months into the future. Now, we said that volatility is expressed as of 1 year from now. It's a 1 standard deviation move 1 year from now. So we're going to back this up a bit. We're going to haul this thing back. And we got the price going up. And as of right now, let's just say that the price of the Russell is at 825. What do we mean that volatility is at 18%? Okay, now remember, 1 standard deviation price change in the asset as of 1 year from now expressed in percentage terms. Okay, so let's look at this, 18%. If we take 825 times 1.18, okay, gives us a price of 973.5. That's of 1 year from now. So we're going to go out 1 year. 1 year. There it is right there. 973.5. And when we draw our bell curve going out into the future, this is what we mean. This is the distribution of prices if volatility is at 18%. The price is at 825. Okay, so that's just a little backdrop in case you didn't know what volatility meant. All right, now, how do we get that 18%? How is volatility derived? And we look to two different sources. In the world of options trading, we look to two different things. First, we look to the actual underlying security itself. Okay, you're trading the SPX, we look at the SPX volatility. You're trading the Russell, we look to the volatility of the Russell index. You're trading a stock, you're trading Apple, you're trading Google, we look to the stock itself and see how volatile it is. Well, when we look to the stock or when we look to the index, we look at it from a couple different perspectives, and I'm just going to, most of us are familiar with historical volatility. I'm going to introduce you to statistical volatility, okay? And then we're going to look at implied. Let's just look at historical. I'll show you implied after this, but let's look at historical first. And this is something you can dial up in your Metastock program, and I'm a Metastock fan. That's my, programmable charting program of choice. I think it's awesome. And what historical vol is, it's a and this is important, it's a close-to-close calculation over a certain number of periods, 5, 20, 100, etc. And here's, I'm giving you the Metastock formula for those of you that want it. You can program that into Metastock and see what it looks like. And here, let's just do that right away. In Metastock, you can program in historical vol. And so if you look back over the last 20 days, okay, of course you're taking the square root of time and all that stuff. And here's the standard deviation part and all that in the formula. But you get this grid, this graph here in the red, and you can kind of see pretty clearly when the market drops, that's when the volatility rises. Okay? When the market starts slowly going up, that's when historical vol drops. Makes a lot of sense when you're looking at the SPX, Okay, so, and of course, with the big crash like this, of course, it's really rising like that. Okay, now, let's look at statistical, because this is the way OptionView likes to look at this, and we're going to kind of tee off on this angle when we go to our indicator to help us make heads or tails of all this. Statistical is going to help you look at the extreme levels of each day, the extreme value approach. And what we do is we use each day's high and low price over a certain number of periods, not close to close. Historical vol is close to close. Statistical, we're looking at each day's high and low. Now here's the Metastock formula for that. And when you run that through Metastock, okay, we're looking at a 20-day statistical volatility versus a 20-day historical close to close. This is the highs and lows. You can see that the two graphs are very, very similar. The statistical SV is just slightly a little bit smoother perhaps than the historical vol. Okay, a little bit smoother there. All right, now those are two ways of measuring the volatility of the underlying asset itself. Now, separate from that, we're going to go to another way of getting volatility, and that is we're going to look at the option prices themselves. Whole different ball game. For those of you new to options, it's important that you understand two types of volatility. The kind where we look to the asset, the kind where we look at the option prices. Now, when we look at to the option prices, All right, we're looking at the time premium, and the technical definition here is the implied volatility is the volatility that, when used in a pricing model like Black-Scholes, that volatility level yields a theoretical value for the option equal to the current market price for that option. Okay, now what does all that mean? All right, let me dial up a diagram here. Maybe some of you have seen this. Okay, here's the Black-Scholes model, this little blue box here. That's what Black-Scholes there. Now there's the Cox-Ross-Rubinstein, Len Yates and our company, the founder of our company, altered the Black-Scholes to account for the possibility of early exercise because that does affect things. Okay, so it's a refined Black-Scholes. But you got this pricing model here, and into that calculation, into that complex algorithm goes the price of the stock, the volatility level, the amount of time left in the life of the option, what strike price we're at, the current interest rates, and any dividends. And you crunch all that through the Black-Scholes and you get a theoretical price. Now, here's how we get implied volatility. What happens if we know the price? We know the price of the option. Let me just click the button here. We know the price of the option. We know the stock price. We know how much time is remaining, the strike, the interest rate, dividends. We know everything here except the volatility level. Okay, and so when we know the option price, we crunch it back through. In an option view, we do a series of iterations to then wind up with a volatility level implied by this option price. We call it implied volatility, or IV, and we can take each option's implied volatility, average them together, and we graph it on a grid just like this, a graph like you see right here of the Russell. We call this a volatility chart. And it's a, and to look at it, it's kind of like, what in the world, what in the world? Well, what we like to do with these are a number of things, and we can really start to see, if you know how to read these, you can start to see immediately which assets are good for premium selling and which are bad for neutral premium selling. If you're going to go down this road and sell premium neutrally, you got to understand how to read these charts, both implied and statistical. Okay, you can't just focus on one or the other. You got to look to both and understand what you're looking at here. What we like to do is superimpose the price chart of the Russell in this case on top of the on top of the vol chart. And another thing we can do is bring up the averages for the different types of volatility. You see that? And let me just take a careful look here. Notice here the 6-year average of the implied volatility of the Russell options is at 26.5. The 6-year average of statistical is at 24.7. And in every single time frame going back, we can see that implied on average is higher than statistical. And what this is telling us is that on average, the options are implying, the time value in the options. The time value is implying a volatility level higher than what typically comes to pass in terms of how much the underlying asset moves around. And we would label these then chronically overvalued options. Chronically overvalued. There is something inherent about this options market that makes the options chronically overvalued. And this is very important when you go to sell premium neutrally, because just by simply doing the Russell, you now have an inherent volatility edge. Okay? And listen to me when I tell you, you know what, you can have all the adjustment algorithms you want for your butterfly or your condor, and you could do high prob or low prob, this and that. You know what though, if you do that in a market that is chronically undervalued, where the options the prices are implying volatility less than what actually comes to pass, that the market is more volatile than what the options are saying, you're going to have a heck of a time. Now, you might make money randomly, okay, but you're going to have an inherent volatility disadvantage, okay, and the clever adjustments you come up with are only going to keep you out of serious trouble. You're you know, in the long run, you'll lose. You got to have an inherent edge, and focusing on markets chronically overvalued automatically puts you in the place to at least get off on the right foot, okay? So that said, what's next? Oh, I want to show you in Option View, we have this thing called OpScan. And what I like to do is run this OpScan where I am looking, I can scan the indexes for markets that are chronically overvalued. And what I'm going to do is compare the 500-day average of that blue line, that's about 2 years, it's a 2-year average, to the 2-year average of the red line. And those situations where I have the biggest disparity, they're going to pop up at the top. And so here's the report that came out here a few weeks ago. Of course, the VIX is at the top, and I don't want to talk about VIX. Oy, you know, I know a lot of people like to talk about the VIX, but in terms of this stuff and modeling the options, I mean, you know, because the underlying really isn't like a stock with a typical distribution. You have a different situation going on there. And there's the notion of it being a derivative of a derivative several times removed, and it's the tail of the tail of the tail wagged by the dog. And oh my gosh, listen, trading's hard enough. Let's just focus on the indexes and the options and hold it there. You know, now I got to tell you, at the Dallas show I went to, we got a number of people coming up to us saying, hey, you know, I'd like to trade the VIX, and, you know, honestly, I haven't run into anybody saying that they're consistently selling premium in the VIX and making money. I have yet to run into anybody that's told me that. Now, if you're one and you want to share, feel free. Shoot me an email. I'd love to hear from you. Okay, but because we're in the business we're in, and because there's a lot of interest, I know I'm beginning to study the VIX more and more. But here it is, boom, top of the list, and that for that tension here, look at that. You got Implied Volatility, and it warrants higher than the statistical. You got to take a look at it. So, but that said, let's go on down the list, and I go down the list by looking at the volume. I see that the OEX is the most chronically overvalued index that has any kind of decent volume. Next is the SPX. Next is the Russell, the NDX down there. Now, interesting, just as a side note, before the crash of 08, the Russell was at the top, okay, and the OEX was further down. The NDX has always been kind of farther down. Okay, but the Russell was the prevailing favorite for a long, long time before the crash of 08, and since then it's taken a back seat in terms of chronic overvaluedness like this, all right? Just a little aside. Okay, now we're moving towards an indicator. To move towards an indicator, we need to understand the movement of the blue, the implied, and the red, and what they mean. Okay, let me get a sip of, just one moment here. I'm going to turn the mic off for just a few seconds. Let me get a drink here. You know, when you drink carbonated anything in these situations, you got to be careful. So my apologies beforehand in case something happens. All right. What are we looking at? Okay, so let's take a look at this volatility grid here, and I want to point out to you the notion of implied volatility here being different from statistical. What's the next thing? Okay. Notice here, let's just say we're back here in March. This is March of last year. Let's say we sold premium at 21. Now, a lot of people would look at this and go, gosh, you know, look at the separation here between the implied and the statistical. Look at that separation. These options are overvalued. It's time to sell. Well, you're looking at apples and oranges, and here's why. Implied volatility, let me just throw this out. You don't have to type in your answer. Just answer this to yourself. implied volatility is the blue line, the implied volatility of the time premium in the options. Is implied volatility a predictor of the future, or is it a measurement of the past? The implied volatility of the options. I'll tell you, the implied volatility of the options is a measurement of the trader's expectations for the future. It's measuring expectations for the future. Now, the red line, is that a measurement of the past, or is it an expectation for the future? It is a measurement of the past. So the blue line measures the future, the red line measures the past, and you can't really look at it and make a conclusion just because of a separation that occurs at any one moment in time here. Instead, we need to look at the volatility implied when we sold options, and then we have to go a month later and ask ourselves, okay, if we sold premium at a 21, what happened a month later? Well, we can look at a month later and see, yep, sure, over the past 20 days or so, the underlying asset had a volatility level of about 17 or so. All right? So that's what happened there. Now, watch this. You know what? I really want to get rid of this. How can I hit that eraser? Boom, 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 boom. Perfect. Come back, grab that. Perfect. Okay, next. Let's move it over here. In April, implied volatility was at 20. Right? It was above the red line, right? Look what happened. If we had sold premium then at a 20, we go a month later, and we can see that what happened is that the market ended up trading at about a 38% IV. That was through the flash crash and all that mess. So in that situation, it would have been, this is what would have gone wrong right here, is that statistical volatility went up, and when it did, it quickly rendered the premium you sold here undervalued. Watch this. Statistical volatility started going up. It went up so much so that it rendered that volatility level undervalued at the time. This is what can go wrong. Okay, what can go wrong is that SV trends upward. When SV trends upward, big letters, watch out. All right, and so in terms of premium selling, okay, I think you would agree that that price action up here, this would have been a mess to trade through. Holy cow. From a neutral perspective, it would have been misery. That would have been a life-changing experience had you hung in there and tried to trade all throughout that mess. I hope none of you got caught up in that for too many days into that mess. We're working in towards an indicator that would have kept you out completely, though. All right? So this is what happens when things go wrong. SV trends upward. Put on the brakes. You better watch out. Now, how can we put some measurement on this? All right? This is what happens when things can go wrong, and this is what happens when things are not right for selling premium, is when SV is trending upward. Bottom line, when SV is trending upward, we got to be able to measure it, and we got to be able to quantify it so much so that we can have a green light, red light, yellow light, whatever, saying, you know, slow down or stop. And that's what we're working to. How do we know that SV is trending upward? So, now look, some of you guys are pretty smart. I know some of you guys here. Look, you can come up with your own indicator. I'm sure you can look at that red line and do trend line work. Some of you might have great thoughts of programming in Bollinger Bands. I don't know what you want to do, but you know, I just went down this path. This thing struck me, and I said, you know what? We got to quantify this somehow for ourselves, and I'd invite you to come up with your own approach to quantifying an upward trending SV. I'm just going to give you one approach, and I'll give you the code and everything for it. It's nothing hugely magical, but I think it's extremely important. How do we know SV is trending upward? We're going to just take a very simple moving average and apply it to statistical volatility. So if I went in Metastock and I ran the statistical vol, the SV line, and I slapped a 20-day exponential moving average onto that SV line, I get this nice little look here that's pretty clear. You know, when the SV is above that moving average, you know, it's trending upward. When it's beneath that 20-period exponential moving average, it's trending down. It's very simple. Okay, now what's my next screenshot? Okay, all right. Here's the thing though. Many of us do not have SV in our charting program. Okay, I had to program SV into Metastock. It just didn't have SV sitting in there. Okay, SV was kind of it was really developed by Len and procured in our software way back in the 1980s when he started charting statistical volatility and comparing it to implied. And today, when I start building an indicator like this, you know, there's something we need to have a surrogate. Basically, we need to have a substitute for SV. And what's easiest, and it was easiest in option view just to program this in, because we now have this indicator I'm going to show you in the program. We use the concept of average true range. This is a wonderful surrogate for statistical volatility. I think it's better than historical volatility. I think this is the best volatility determinant that you'll find in an easily accessible, you know, any of the free charting programs out there. You can dial up average true range, do a 20-period measurement on this, and you're going to see the volatility of the underlying index really well. Now, what is average true range? So I want to explore this, and we're going to back up into an indicator. But this is just a great surrogate substitute for what we're doing here. True range, this is developed by Wells Wilder back in the 70s. True range is the largest of any of these three items here. And the first one, over here, day one, it's the largest of any of these three definitions. First, in this particular instance, today's high minus today's low. That measurement yields the highest value, and in this case it's 30 points. The next day comes. In this particular day, the definition that yields the highest value is this one. Yesterday's close minus today's low. That yields the highest. Do you see how it accounts for that gap? That downward gap right there? And that's the beauty of the average true range measurement, is it can incorporate and include gaps in incorporating it into the volatility concept. Finally, the last day that you see is day 3. Look at this big gap to the upside. Okay? This would be the middle one. Today's high, okay, minus yesterday's close. Do you see that one? Today's high minus yesterday's close. You know, it's a little later here in the Midwest. One moment here. I'm the cleaning people here. Just a second. They're going to vacuum tomorrow. That's awesome. Okay. All right, so here we go. So this is average true range. We take each day's true range, and we take a 20-day average of it. So here is SV, and here is ATR 20. Look how close it looks compared to SV there. You see that? A little smoother, of course. It's a little smoother. It's a lot smoother, actually, but you can see the general shape. And because what we really want is the trend of volatility here. When this ATR 20, look how it resembles SV. What we can do then is take the ATR 20 and just like SV with its 20-day average slapped on top, we're going to do the same thing to that ATR 20. We're going to put a 20-day average right on there, and we can see when ATR 20 is trending upward, okay, that's when really statistical, we're going to call it statistical is trending up. Volatility is trending upward there. When it's underneath that moving average, it's trending down. Okay, so that kind of concludes a sequence. Give me I tell you what, give me 5 seconds. I'm going to have a little bit more of my carbonated beverage, and I'll recover, and I'll be ready to come back, and we're going to pick up right where we left off. Just turn around, stretch your legs, and give me 5 seconds here. One moment. And we're back. Okay. Before we kick off, I do want to remind you, at OptionView, we have a great website. Those of you that haven't tried our software, come here, get a free trial. Those of you also that want to really study this volatility indicator more in depth can come to our website, click on What's New. Get the March edition of our OptionViews newsletter. I wrote an article about all this that expounds on it, and you can kind of, if you have it in print then. And of course, you can click here and look at our mentoring program as well. We, the four of us are up there. Frank, Steve, Ken, they manage money professionally and also mentor on the side. And we've carved up our curriculum into 3 levels. You can go to the website and check these out. Whether you're beginner, intermediate, or advanced, you want to do portfolio management with options, directional spread trading, or the non-directional stuff we're talking about now, that's level 3. We have a place for you here, and if you want all of it, of course you can get all of it, and we'll take $1,000 off. And of course we also give you plenty of OptionView subscription time with all of this. Okay, so we've thought through our curriculum. I think it's very, very complete. And I'll tell you what, these guys that teach it are, Frank and Steve go back to the mid-'80s on the floor, and they've both, and Ken also, established themselves as solid, off-the-floor, upstairs traders. Okay, and it's important to know that you would be working with someone and a group of people that are established as off-the-floor traders after coming off the floor and having to kind of relearn the skills to succeed off the floor like this. That's important to know because there's a lot of services offered out there by lots of people. And so anyway, if you're interested at all in education, give us a call. We'd love to hear from you. And we have some good guys that will be glad to inform you about everything we offer here. All right, going to the picking up where we left off, average true range with that 20-day moving average there. Okay, now we're going to build an indicator that gives us kind of a red light, green light, kind of a, well, not, you know, kind of an approach. What we're going to do is proceed down this path. We're going to take that average true range and its moving average. We're going to create a histogram of it. All right, now a histogram is simply going to kind of be a bar chart showing us the distance between the moving average and the ATR 20 here. So on the histogram, and here it is, if the ATR 20 is above the moving average, well, then we're above the 0 line here. If it's below the moving average, well, then it's below 0 over here. You see that? Okay, so that's just, it's called a histogram. And that's kind of cool looking. But here was my thought going into this. And this kind of drives me nuts about the options world. Whoever thought of this put-to-call ratio thing? I don't know if this, am I the only one this drives crazy? You know, when the put-to-call ratio is at an extreme high or it's trending upward, is that bullish or bearish? Okay? Well, when it's going upward, it's bearish. And then when it's coming down, it's bullish. It's inverted in my head, and I have to keep stopping, taking a deep breath, roll my eyes upward as I think about the inversion of the relationship between the trending of the put-to-call ratio and the actual underlying market. Drives me crazy. Why didn't they just call it the call-to-put ratio? I mean, come on. Right? Just make it cool, you know, congruent with the way the brain works. And so I'm looking at this going, you know what? When I want to have a green light when the histogram is positive. I want positive things to happen when the number is above 0, and I want negative things to happen when the histogram goes south, and it's not happening for me here. So what I did is I just inverted this thing. just simply inverted it, flipped it over just like what you see there. Okay, so we invert it like that. I slapped my name on it because I've been at this a number of years. I said, what the heck? You know, I may as well do it. I thought of this thing. I think it's extremely helpful. So we call it this. Len Yates was kind enough to program it into Option View and, of course, included in our newsletter, and I appreciate that. There's the metastock code. As a narrative, I would tell you that the LVI is it's an inverted histogram of the difference between the 20-day average true range and its 20-day exponential average. Real simple. Now, here's what is real interesting about this. When you look at this, and we inverted it for this reason, okay, is that when it's positive, that's when it's okay for us to do non-directional option strategies. When it's positive, statistical volatility is trending downward. It's underneath its moving average. And that's a good thing. We want to sell premium when it's positive. When it turns negative, okay, well then we want to exercise caution on our condors. Maybe we want to cut the size down, maybe cut it in half. Most conservatively, you may not even want to do them at all. If you have other things you're doing, you know, employ those other strategies perhaps. But when it's negative, you know that statistical is trending up, the red light is on at minimum, the yellow caution light should be on, and you should be cutting size or most conservatively even not doing, you know, non-directional premium selling at all. All right, that's kind of the reason this was developed. Coincidentally, though, I think it's interesting that when the histogram is positive, in the world of equity indexes, it generally is a confirmation of a bullish trend. Okay, when it's negative, that conforms with bearish seasons. Now, is this coincidental or is it a leading in? I think it's more of a coincidental thing. I don't think you can hang your hat and go long when the thing turns positive and go bearish when the, you know, put on short, you know, start selling naked calls when the thing turns bearish. No, no, no. Okay, use it with other stuff. I just like the inversion of the histogram to conform with bullish and bearish tendencies. Okay, that was just kind of an aside there. Now, here's how to apply it. We're winding our way down to the application of this thing. I noticed in looking at this thing over a ways that, you know, sometimes it'll turn negative for just a day or so and then pop back up, or it might go positive for a day and then turn back down. You want to wait for at least 2 consecutive measurements on one side of the zero line or the other before you make a conclusion about this, okay? So make it be negative for at least 2 days before you draw a conclusion, or make it be positive for at least 2 consecutive days before you draw a conclusion, okay? All right, and that's just, you know, my opinion on how to use this and after looking at this for quite a while. Another thing to kind of remember, and I just, you know, in terms of the bullish bearish thing, okay, after a huge sell-off like the flash crash period, because of the relationship between SV and its 20-day moving average, you could end up having a false reading here in terms of that bullish bearish thing we talked about, okay? It's just after a huge, huge sell-off, okay, the kind that occurs once every 5 years, okay, in this case, twice every 5 years with 08 in there, you know, a huge big sell-off, you got to kind of watch that if you're watching for the bullish bearish confirmation. So just as an aside. How would this thing have done going into the crash of 08? How would this thing have done going into the, what's my next slide? Okay, I wanted to come back here. Before I go to the crash of 08, I just want to point out to you, going into the flash crash of 2010, look at this. We had our consecutive days hit before the flash crash. Look at this. The market started getting volatile. Even though it was going up, it started getting volatile before the big flash crash on May 6th of last year. And had you been observing this thing All right, this would have given you huge pause. Okay, going into it, we would have had several negative days in a row here to alert you that, hey, you know what, the environment is getting kind of shaky here. And you would have saved yourself a lot of grief going into this if you had watched something like this to kind of alert you to the increasing volatility in the market, that maybe something was up, kind of like tremors before the earthquake instead of tremors after the earthquake, kind of some pre-seismic activity, so to speak here. Let's look at the crash of '08. Did anything, did this kind of alert us then as well? And sure enough, in the crash of '08, we started having more volatility before the crash happened, leading up into the second week of September. We had multiple days in the negatives. Okay, even though we had some congestion, we started having some negative readings in this thing, and of course, blammo, look what happened, of course. Now, the blammo, what happened didn't happen because of this. This is just a little bit, this could have been a warning signal to us that we're selling premium neutrally at the time. Okay, let's look at a weekly chart. This is just kind of fun. I just threw this out there. This is the current weekly chart. If you dial up a weekly chart of this, you can kind of see some long-term confirmation of bullish and bearishness going on between the indicator and the underlying market. Kind of a confirmation there. It's kind of interesting stuff. I haven't, beyond looking at this chart and kind of smiling and saying that that's cool, I haven't done a whole lot more with that in terms of developing any systems or anything. Here's where we are today. I'm looking at the Russell. I should have brought up the SPX. We do a lot of Russell work. I know you guys do too. But in the Russell, you can see we've been negative for a bit here. Okay, we've been negative for a bit, and it's been rough sailing the last couple months here for the premium sellers, hasn't it? And you can kind of see that the indicator's been negative quite a bit of the time. Okay, now it's coming up. It just turned positive here today. We'll see we'll see kind of what happens moving forward. If we have another positive day or two in the future, things could turn around. But that's kind of where we are right now in terms of looking at the Russell here. Okay, and that is it. That's our website. And I am open for any questions you guys might have. Be glad to take those if you want.
Well, Steve, thank you very much. Probably the first thing I want to do is I have a couple comments here about the presentation. One I found interesting was John Dory says he worked for Rumsfeld when you were talking about the desk, and he says I guess Don Rumsfeld used it because of back issues. But
I'm using it for health issues. I want to get more fit and not go down the road I've been going. But yeah, I heard he did that. Rumsfeld was a big stand-up desk guy.
So I got a couple of comments here that your explanation about volatility was one of the best explanations several of our members have heard ever. And so I have some comments saying thank you for doing that, because they learn more in this presentation than they have elsewhere. I have one question. If you could explain perhaps again let's see, where did I lose that one? Can you please explain the SV, standard or statistical volatility, and IV, implied volatility percentiles?
Oh, certainly. Let me see if I can dial up I'll just go back here and try and find a volatility chart where that would, I hope it was even shown. Oh, here we go. Okay. All right. Let's look at, you can see the Russell chart, correct?
Yes, we can see it.
Excellent. Okay. Up here at the top of the chart, and let me just erase this. Oh, it just drives me crazy sometimes, all my little markings. Okay, that way I can focus here. And you know what, I want to go back there. Okay, in option view, we display these numbers up at the top, IV and SV, And there's a number in brackets. And what that is saying is that over the life of the chart, going all the way back, now some of these charts go back to the late 90s. Okay, it used to be that these were cut off at 6 years, and we increased the distance that they go back. But here's how it goes. Over the course of the life of this chart, however long or short it is, okay, that percentile ranking, that is saying here, IV 49 is saying that this IV, and I'm using my red mark on the right side, IV in this location has been lower than this 49% of the time, and it's been higher than this 51% of the time. Okay, now that contrasts to a, I'll call it a decile reading, where you might say that IV is in the lower 10% of its 6-year range, something like that. No, this is in terms of a percentile over time. So when SV is at 47, that means that it's been lower than this 47% of the time. It's been higher than that current level 53% of the time. So there's a time element with regards to the percentiles. That's important to know. It's different than the, some of the things you'll see. I know people do like to look at where it's at in terms of its 5-year range, 6-month range, something like that. This is a percentile ranking in terms of time.
I have questions about programming the LVI for different platforms. The most popular one being mentioned is Thinkorswim, as well, and the NinjaTrader has also been mentioned at least once or twice. I think I saw on your forum, Steve, that someone had posted the code for programming the LVI onto the TOS platform.
Yeah, I think you're right. If you were to go to our forum, you can just go to our website and click the forum link, go there. What is it? Forum.optionview, forum.discoveroptions. Yeah, James Hogan in our office did that because he uses Thinkorswim, and he is, for his trading, he's with them as a broker right now, and he did pencil out that the algorithm to put that into the TOS platform. I can't speak to NinjaTrader though, unfortunately. I was just going to dial up my Metastock. Where is it? Here, let me zip on down again. Okay, there it is. Down at the bottom there, if you could just write that, you might be able to easily then take that and translate it into your platform's language. It's simply 0. This is the number 0 minus, and then in brackets, the ATR 20 minus the moving average of the ATR 20, the 20-day moving average exponential there. Okay, now this is the Metastock language. You can just write that, and I think it's fairly simple. I like Metastock because of the Excel type language. It's kind of self-explanatory, or at least it is after you use it for 12 years.
Okay, we got so here's a question. It says the LVI seems to lag the market a bit, probably because it uses a moving average to smooth the data. Would the raw, unsmoothed data be a better indicator of impending danger of increasing volatility?
Well, when you do that, let me just think what that would look like. You could look at, I'd have to think about that. What would that look like then? You could take an ATR, you could start with each day's true range, and you could, if you don't smooth it, then you're going to have something that really freaks out whenever you have just one day that's really a big gap. It's going to be much more volatile then, certainly. And I think too, it's important to remember that we're doing this in the context of premium selling strategies that typically, at least for us, we like to put ours on at least, I'm going to say 35, 45 days of life left in the options, and then we have our positions on for 2-3 weeks, something like that. Some of our guys go out farther. Some of our students and our money managers that are more conservative, some of our students that are money managers, they're going out much farther in time, and so they would want something certainly, smooth like this. So the smoothing level that we have here suits at least our strategies pretty well right now. Now, I'd have to put some brain cell time to shortening it up, and in what context. There might be some validity in doing that in terms of shorter term decisions you make, perhaps with adjusting, something like that.
Yeah, the only comment I have about that is, the one way you find out whether it's going to work or not is you test it, and so if someone's thinking that maybe they know a better tweak than what you came up with, the one way to do it is try it and see if it works in some respect.
Well, I'll tell you one tweak that's been suggested a couple times, and I initially looked at it and concluded, boy, let's just keep things simple. But I have had some people say, you know what, why don't you throw a moving average onto the indicator itself so that when it starts to turn up from a very low position, you would have an early entry. Instead of waiting for it to cross the zero line like I'm pointing at right now, okay, you could get into it earlier if you had a little moving average that signaled you that, hey, maybe things were quieting down a little bit more. And I do have some students that even today, I had one guy today in my class, he says, well, the indicator's turning up or turning down. The fact that it was whether it was below zero or above it didn't matter to him. He was looking at the direction the indicator was traveling, which I kind of thought was interesting. So that's a little twist. And again, like you said, Chris, testing is so important. I personally haven't gone down the road of throwing on a moving average on top of it. I think one could maybe, and then have a little, like a whole nother stage of money management in there. If you're going to vary your contract size relative to the volatility environment, you may want to have a multi-stage, look like that rather than the 2 stages that I presented here.
Yeah. Well, Steve, I want to thank you very much. I know we've run over our allotted 1 hour, and you're a couple hours ahead of me time-wise. So I want to let everyone know that the presentation was recorded, and I'm going to post it on the website if you want to watch it again. But Steve, again, thanks for joining us, and good work on the indicator here.
Well, thanks, Chris. I really always enjoy getting with you guys and talking to you about options. I just love this subject. So thanks a lot, guys. Thanks for having me.
Yeah. Well, you have a good evening, and thanks for everyone coming out. It was a good presentation, and I hope you guys have been able to take more than 1 or 2 things away from it. So you have a good evening. I'll be in touch. Bye.